And if you are an ordinary shareholder in an ordinary company who receives a dividend on your shares, even if you're doing work for no salary or a low salary, you're a director, you have no contract of employment, you choose to take a salary of, I don't know, 6 grand, 10 grand or whatever, and you choose to top it up with thumping great dividends, is that right for attack? Absolutely not. Absolutely not, in my view. If you provide a class of share to employees so that you can pay employees dividends instead of earnings, is that right for attack? Not at all, in my view, providing you alter the employees' contracts of employment. They would have to work under a contract of employment which basically said, we accept that our salary is national minimum wage or whatever. If they do that and then get topped up by way of dividend, in my view, no problem at all with that, because I do not believe that the revenue could successfully argue that dividends in those circumstances were anything other than dividends. But the bigger point is, that I was asked to comment on, is it like to change? Because it is perverse, isn't it? If you go back long enough, I told you about Geoffrey Howe's budget slashing the rate of tax from 98% to 75%. Why was it 98% and why was it 75%? It was those rates because it was, and this is going to sound terribly ridiculous, 75% was 60 plus 15 and 98 was 83 plus 15. And what was the 15? The 15 was something called investment income surcharge. In those days, investment income was taxed more highly than earned income. And it wasn't only those days. If you go back before, I mean, this is terribly boring for some of you youngsters, but if you go back before 1973, before they had what was known as the unified tax system, before then, you had income tax and you had surtax. If you're a higher taxpayer, you didn't pay higher rate tax, you paid super tax or surtax as it was called. And there was no investment income surcharge, but what there was earned income relief. If you had earned income, the first thing you did when calculating how much tax you had to pay was knock off a fraction of your earned income, which I seem to remember was 2/9. So you got a deduction. So then 73 came and they had introduced a tax system more or less as we know it now, but no earned income relief, but investment income surcharge. Now, it wouldn't be beyond someone's wit, would it, to think, let's introduce investment income surcharge again. You could easily do it at a relatively high level to protect the little old ladies and the pensioners and all that, but it wouldn't be beyond anybody's wit to do it. And I leave you with this last thought while you're cogitating on that. Think on this. If you are a nurse, let's pick the most angelic member of society that we can think of. So we'll choose a nurse. On my left-hand side, I have my nurse. In the red corner, we have a nurse who is on, let's say she's earning 25 grand a year or something, doesn't matter. What is her marginal rate of tax and national insurance contributions? Well, her marginal tax rate is 20%. Her marginal national insurance rate is currently 11, soon to be 12. And her employer, whether it's the NHS or some private hospital or whatever, is paying currently 12.8, soon to be 13.8. But for the nurse herself, or himself, the rate of tax at the margin, well, the rate of tax and national insurance at the margin currently is 31, soon to be 32. Yeah? Think about that. So on my right hand, in the blue corner, what do I have? I have what I think are known in the trade as trustafarians. What? Trustafarians, bright young things who hang about Sloane Square, who live off their trust fund, who do nothing all day, but daddy provides and they have trust income which comes in regularly. I don't know, Tara Palmer Tompkinson, let's say, or someone like that. So they've got income, but it's investment income. What's the margin rate of tax on that? 20%. There is a huge difference between our nurse on the one hand and our trustafarian on the other. And why is there? Because the trustafarian doesn't earn. Because not earning anything, not doing anything, just rolling in investment income, the rate of tax is lower. is that politically acceptable? I mean, I could easily, I could stand on the soapbox and easily make a good case for that being unacceptable, as I'm sure most people here could if they wanted to. I just make the point. So there is no straws in the wind that I know of to bring back investment income surcharge, but it seems to me it would be very easy if the government thought we don't like this national insurance avoidance by using dividends. The solution is easily within their grasp. Investment income surcharge would be the solution. So, on that happy note, let's move on. So my brief was to talk about capital gains tax. I've already sort of done entrepreneur relief, although if anybody's got any questions, if they think I didn't cover it fully enough, then feel free to shout out. What I want to do now is talk about capital gains tax in a I don't know, a fairly rambling way, I suppose. So let's go back to the beginning again. I love the history of all these things and just thinking about how it developed. Capital gains tax was introduced from the 6th of April 1965 by the then Chancellor Jim Callaghan, Sonny Jim Callaghan. What was there before that? Well, sort of nothing. I say sort of nothing. There was income tax, of course, and there was a period in the income tax code where there was an income tax charge on short-term gains. There was something called Schedule D Case 7 for a while. So there were attempts to tax capital gains in certain ways at certain times, but broadly speaking, there was no tax on profits made in a capital form. Okay? So what happened? Well, they introduced capital gains tax. And what is the thrust of capital gains tax? Well, the thrust of capital gains tax, of course, is to expose to tax these gains that I've just been talking about, these capital gains that were otherwise not being exposed to income tax, to bring them within the income tax, or bring them within the tax net. The concept is that certain assets are not within this regime. Now, why would certain assets not be within the regime and certain assets be within the regime? And that is an easy one to answer. It is partly political and partly economic. Let's deal with the economics first. Most of the assets which are not within the capital gains tax regime are assets which are more likely than not to give rise to a loss. Because one of the fundamental features of capital gains tax is that you calculate gains and you calculate losses in the same way, and if you have a loss, you can deduct it from gains. If you have a loss that exceeds your gains, you can't carry it backwards, you can only carry it forwards, but you can carry it forwards and offset it against your future gains. I mean, that's the sort of fundamental concept. That fundamental concept has been meddled with effect from a date in December 2006, which I can't remember. I think it's the 16th or 9th of December 2006. A piece of legislation was introduced which is called a Targeted Anti-Avoidance Rule, a TAAR. On one of my earlier slides, I skipped over the concept of introducing a general anti-avoidance rule. I didn't talk about it because there's nothing to say about it really, but a targeted anti-avoidance rule was introduced with effect from the 9th of December 2006. The effect of which is that if you trigger a loss for the purposes of obtaining a tax advantage, and the words tax advantage is defined as meaning a relief from tax or a repayment of tax or a lower exposure to tax, I think, or the way it's defined, you do not get relief for your loss. So generally the thrust is losses are deductible against gains, but they have now introduced something called Section 16A of the Taxation of Chargeable Gains Act, under which certain losses are not relievable. And the Revenue on their website posted all sorts of questions and answers about the circumstances in which they'd use this, and some of the circumstances you think, my God, this is an outrage.